If you are looking to invest in something, you have thousands of choices. You can choose from a variety of instruments such as stocks, commodities, bonds, alternative investments, etc. An asset class is considered a group of different securities that possess similar risk-return characteristics. The price of assets within one asset class usually move together. One of the most popular asset classes is equity investments, more widely known as stocks. This type of investment allows the investor to claim ownership of a company and have possession of a part of the company's assets and revenues. Issuing stock for investors to purchase is usually done by companies when they need capital to finance their projects. Each investor who owns a stock owns a share of the company and is entitled to receive a proportion of that company's profit. These profits are usually paid in the form of dividends. Stocks can be two types: common stock and preferred stock. Common stock is the type of stock most investors trade. Preferred stock is rarely issued and traded. Fixed income investments, as the name suggests, offer fixed payments at regular intervals to investors as a return to an initial investment that the investor has to make. Fixed income instruments are born when an institution, a government, or a corporation raises capital from investors. This capital is in the form of a publicly traded loan. Rather than going to the bank, these organizations ask for money on the open market and promise a certain return, just like the interest rate on a loan. Most publicly traded loans are called bonds. Bonds are the most common type of fixed income instrument, although they are not the only type. In spite of its name, a fixed income instrument constantly changes its price once issued. Commodities are the building blocks of many things that people tend to use on a daily basis. They are components of almost everything you see in the real world. Commodities include precious metals, industrial metals, agricultural products, fuels, and even CO2 emissions. They are traded in standardized sizes or batches on organized exchanges around the globe. Here is a brief list of some of the commodities with the highest liquidity. Precious metals: gold, silver, platinum. Industrial metals: copper, aluminum, lead, zinc. Fuels: oil, coal, natural gas. Agricultural products: wheat, corn, sunflower oil. Gold is one of the most valuable and most frequently traded commodities in the world. Gold is different than other commodities in that it is considered money. In fact, it has been used as money since ancient times. Unlike paper money, which is considered valuable due to a government decree, gold has intrinsic value. Its value can never fall to zero regardless of the circumstances. Other widely recognized properties and advantages of gold are rare, almost indestructible, malleable. The demand for it is rising. Gold has been among the best performing assets in recent decades. It has outperformed currencies in both terms of risk and return. Gold has also been consistently outperforming stocks. The term investor is mostly used when talking about long-term investment, whereas the term trader and speculator are used for someone who makes the short-term investments. Nonetheless, these terms can be and very often are used interchangeably. Investor equals trader equals speculator. Financial markets are divided according to the asset class traded on them, e.g., equities, exchange, bonds exchange, commodities exchange, etc. Markets have different indices that indicate whether prices are rising or falling. S&P 500 index, Dow Jones index. When a trader buys an asset, he is said to take a long position or go long in that asset. When a trader sells an asset, he is said to take a short position or go short in that asset. When a trader wishes to trade on a market, he places an order. An order can either be a market order, executed immediately, or a limit order, executed when the price on the market hits a designated limit. When we use the term bank, we usually refer to commercial banks. However, there are other types of banks: investment banks and central banks. Commercial banks are financial intermediaries that channel funds from borrowers, those who take a loan from the bank, to lenders, those who deposit their own money in the bank. Banks are nothing more than resellers that purchase funds and sell them in the form of loans, with the selling price being the interest rate of the loan. Commercial banks are based on the principle of fractional reserve banking. This means that out of the deposits they receive from people, they are obliged to keep a certain percentage of that money in their vault and not to lend it. An investment bank hardly fits the classical image of a bank the average person imagines. In particular, investment banks primarily deal with public offerings, mergers and acquisitions and trading. Investment banks differ from commercial banks in that they do not give out loans and do not accept deposits. Investment banks are among the most active traders on the financial markets. Along with other large investors such as mutual funds and hedge funds, they trade huge quantities and thus have a great impact on the market. Some of the biggest names in the banking industry have both a commercial bank and an investment bank division. These include Morgan Stanley, Bank of America, Goldman Sachs. In contrast to commercial and investment banks, central banks are not private, but are public institutions. A central bank of a given country is a regulatory organ that monitors and supervises the health of commercial banks in this country. A central bank also exercises monetary policy. It can print new money and it can raise or lower its interest rate, also called the base rate. In this regard, one of the most closely watched central banks around the globe is the U.S. central bank called the Federal Reserve. The decisions on the U.S. dollar base rate that the Federal Reserve makes have a great impact on financial markets. As mentioned, central banks can print money and can lower interest rates, which is exactly what has been happening for the past decade. This has caused paper money to lose its value. As a protection against this loss of value, gold is purchased by people who want to keep their savings immune from central bank actions. Yet, there are some drawbacks to gold exchanges. Gold is sold at relatively big and expensive increments that are neither easy nor safe for online transaction. You can only speculate on gold, but you cannot use it as payment. This is about to change soon as the market expects a new entrant, an innovative product called Aurum Gold Coin, which represents a combination between gold and cryptocurrency. Aurum Gold Coin is a hybrid currency that combines the intrinsic value and price stability of physical gold with the security and low-cost transferability of cryptocurrencies. Aurum Gold Coin offers a digital wallet similar to a bank account, which is a combination between currency trading account, payment system, and a bullion storage account. You can hold any combination of and/or trade between US dollars, euro, and Aurum Gold Coin. The gold is allocated to a secure vault, and each customer knows the number of the gold bars his coins belong to. Aurum Gold Coin delivers advantages for any kind of purchaser, regardless of whether he is an investor or a shopper.